Hello traders, welcome to today's live stream. Sorry, I'm still just getting myself a little bit sorted here before I share the charts with you, share what's been going on. But I hope everybody is well. It is Tuesday the 15th of April, so not a lot of time left before the end of the month, halfway through the month. I've been in a couple of markets still holding those oil shorts right now, so we can talk a little bit about them in a little bit. It's kind of gone a bit sideways at the moment, so we can talk a little bit about that. Still also holding silver longs at the minute, and we'll see how that one plays out. Obviously, the sort of, I guess, the calmness around tariffs right now, or whatever, no real big headlines coming out at the moment, is kind of keeping the market a little bit more on the sort of positive side than it is on the negative side. We have some key data out today as well. We've had some important UK data as well as some important data out of Canada, so we can talk about that as well. Just give me a second. Let me get my chart sorted. Who've we got in then? We've got Ratish, welcome. Hope you're doing well. Harmy, hello. And Dan, welcome to the live stream. Anybody else out there as well, feel free to say hello, ask as many questions as you would like. Let me share screen with you, and then we can get rocking and rolling. Sorry, I've put you all up on that top screen today, so if I keep looking up here, then that is why. Right, here we go. So some interesting markets lately. Let's bring over the data, and we can talk a little bit about data as well. Actually, what I will do, let's just put the screen there, and we can pop on CAD yen. CAD yen's a market I was actually really interested in shorting earlier. Then I realized there was some CAD CPI data coming out, which was forecast to come in a little bit lower. But I'll show you the reason why I wanted to be short. I didn't get short in the end because the data risk there, I thought, kind of outweighed the risk that I wanted to apply to the market right now. But it did go the way that I anticipated. But I'll show you why I expected that in just a second. Let's get a pen tool up, and we can discuss what has been going on in the markets. So, I mean, a relatively quiet week anyway. If we look at it from the sort of data picture and just have a little look at what is on the sort of data front this week, it is a short trading week anyway. If we just narrow this down to high impact only, it is a shorter trading week. We can see that on Friday we have bank holidays, and Thursday as well, pretty much global bank holidays across the world on Thursday and Friday. There's also a bank holiday in the UK, I believe, on the Monday as well. So, and in Europe. So there is, 2 weeks of sort of lower trading activity within the markets. So Friday, if you get to the charts and realize that nothing's moving around, that's the reason. But it's going to be a very interesting time towards the end of the week anyway. So what key data have we had so far? So nothing really to report on Monday. Markets didn't really do a whole lot on Monday. We did get some really important climate count change out of the UK, and to be honest, didn't really move anything. Didn't really see anything from this. Was it fairly positive? Yes, it was forecast to come in at 30.3, was previously at 16.5, well, revised down to 16.5, came in at 18.7. So basically, forecasts were expected to see more people claiming employment benefits. That didn't happen in the end, and that came in lower. So on the job front in the UK, that's a big plus. Now, I'm a big fan of selling the pound at the moment because the market narrative has started to shift ever so slightly, and you've probably noticed it across headlines and news and whatnot. The shift has kind of gone away a little bit from inflation, has moved a lot more towards GDP, and the projected sort of growth of economies. And, you know, we've seen it across the board in terms of the UK. Really kind of, you heard it a lot about sort of that when Labour turned up and announced their budget. You heard a lot about the fact that forecasts of growth were pretty low in the UK. We focused heavily on that as well. And we're starting to see that kind of narrative bear fruit on the pound at the moment. You're starting to hear it a lot in the US as well, especially as with consumer sentiment coming in a lot lower and inflation expectations in the US climbing significantly. We're starting to see that impact of GDP coming in a lot more. So this would also obviously contribute to that, because usually, or what you probably want to see, or what the Bank of England would want to see right now, is a climate count change that was a lot higher, gives them the excuse to cut interest rates, and then also off the back of that can then be kind of like, you know, applauded, I guess, by critics that they are cutting interest rates to try and stimulate growth and have a reason to stimulate growth. But at the moment, that isn't high enough necessarily for them to even go about doing that. Average hourly earnings didn't climb that much either, but at the same time, you know, this number wasn't necessarily what the Bank of England would have wanted to see. They would have wanted to see a higher number. We've just had some CPI data come out of Canada as well. That was a lot lower than forecasted. So previously we were at 1.1%. Forecasts were 0.7, came in at 0.3s. Trimmed CPI, which is your core CPI essentially, is 2.8. So that's coming down within that sort of target range now, between 2 and 3%. We know the Bank of Canada have been cutting rates. You know, maybe they'll start to think about doing that even more so as oil prices, you know, can potentially continue to kind of sell off in the near term. So we do have some more data out of the UK coming up tomorrow, CPI data year on year, but also we have some really important data in terms of that sentiment again. So is the stock market ready for another sort of drop lower? Core retail sales month on month and retail sales month on month could be a big clue into consumer sentiment, and, you know, are consumers spending in the economy essentially. Retail sales is forecast to jump to 1.4%. So I think anything lower, you know, I don't see us reaching that, but if we do come in lower than 1.4%, the market might take that as a bit more of a serious situation again in the US. Let's just briefly talk about the stock market before I head back to CAD yen and kind of discuss what's been going on there, because we have seen a rebound. We have seen a rebound. I just mapped out kind of a few things to go with tariffs on the chart, just to kind of pinpoint us in the direction of what has been happening in terms of, you know, when things were announced, just kind of key timelines of what's happened. So, you know, we started with kind of Trump's inauguration. You know, then Trump implemented 25% tariffs on Canada and Mexico, 10% on China. Market actually rallied after that. However, when they actually started to be implemented on the 5th of March, and we saw kind of first signs of retaliation, the markets took that very heavily. And then obviously Liberation Day was the kind of push over the edge for the markets, and we saw a significant sell-off. Markets then reacted. We saw bonds falling significantly, yields rising sharply. A number of reasons why that is: economic uncertainty. You know, we've also seen obviously there's a potential that China reacted, and their part of their retaliation was also to dump bonds, as well as Japan. Japan actually hold quite a lot of US debt at the moment. So Japan in retaliation, because they were also hit by tariffs, in retaliation, they could have also dumped bonds into the market as well. So there's still a lot of uncertainty within the markets. And that being said, let's go take a look at the volatility index. I'm going to show you some really interesting charts in a little while when it comes to volatility and stocks. So bear with me on that one. But look at the volatility index. We rose sharply up to that 60 level, starting to come off that now. Market is starting to come towards the 30 area. Do I think volatility will remain above 20? I do, just because there's still that kind of growing uncertainty around. Obviously, we've seen in terms of tariff news, the kind of biggest story at the moment was the fact that things like technology, iPhones was the biggest kind of story. The fact that they won't get tariffed as much or exempt from tariffs. And that's the smart play from Donald Trump, really, because they're going to need tech, they need AI. That's where the next kind of big boom is, or is happening already. So he doesn't really want to tariff those things, because if he does, then it will probably stall the advancements within the US as well. But yeah, very interesting to see that come out. Obviously, that then dampened volatility, because it's kind of showing us that he's willing to almost exempt certain items. And we've seen the volatility index fall, essentially. And we know when the VIX falls, usually the stock market rebounds. And that's what we're seeing in the markets at this current moment in time. Whether that will remain the same, we'll have to wait and see. Maybe there's another catalyst coming where we see the VIX rise sharply once again. I will actually bring up in a moment. Just move that over there a second. Get this over here. I do want to bring on some seasonal charts as well, because I've seen some really interesting seasonal charts, which I want to kind of bring on and talk about in a moment. But yeah, anyway, CAD saw some weakness in the market. One market that I like the idea of kind of being short on was CAD yen. This is dollar CAD's picture at the moment. Not really changed that much. Went down into the 139s after we broke out this 142 level. Again, this was kind of something we spoke about a few weeks ago, in terms of when that liberation day was coming and whatnot. We kind of discussed the fact that Canada, Mexico, China, they already expected tariffs to be hit. And the Canada story, I think, to me, was one that was already kind of overplayed a lot. And, we saw that break at 142. And when we did, we saw that move down to 139, which was, I think, largely expected in the market. But we could see some continuation of that in the near term. Depends how oil prices go, I guess. But looking at CAD yen. So what was interesting in CAD yen? Well, I was watching oil prices all day. So what I typically like to do, let me just expand this up. I really like using correlations within the market. Something very useful. Sorry, guys, I can see your questions coming through. Hello, Precious. Vincent, good afternoon to you. I'm doing really well, mate. I hope you are too. Can you cover dollar yen? Yeah, I can jump on dollar yen in a moment. And yeah, I'll jump on euro pound as well. But one thing that I really love to do, and I think it's something that is kind of underrated within the markets, especially as somebody that's looking to trade the market, to kind of get something out of it, essentially. One of those things is using correlations, within the market. And I really like to look at correlations, especially when I'm active. Okay. Now, one thing that you can look at when it comes to the CAD markets, and I did a video on this today, and this is why it's kind of really fresh in my mind, because I was interested in getting short, is when you apply oil prices over the top. Okay. So I'm just going to add oil to compare. And I'm going to add this to new right scale. I'm going to make this into a candlestick chart. I can make these regular. Okay. So obviously I've been looking at sort of shorting oil. Now, if you didn't want to expose yourself to oil, there are other markets that you can expose yourself to. One of those being CAD yen, because obviously the Canadian market, or Canada, they export a lot of oil. They're big oil producers. They produce and they export oil. And then you've got Japan, who are big importers of oil. So lower prices really helps the Japanese economy out in terms of just trade and whatnot. On the opposite side of that, oil prices being higher is better for the Canadian economy. So what I was looking at earlier was the idea of kind of getting short CAD yen because of this kind of oil play that we're seeing at the moment. Obviously, I'm short in oil right now. The market's kind of finding a little bit of support down towards the 60 lows. But if this does continue to break, then I think CAD yen could go with it as well. So just to kind of show you that correlation here, let me just zoom in. We'll go to a lower time frame, because you can use correlations in all sorts of time frames. You know, it doesn't have to be like the daily time frame, the weekly time frame. You can use these on lower time frames as well. And one thing I was looking at earlier was the fact that oil prices were starting to kind of trend lower here, right? But CAD yen was actually spiking higher. And this is how I like to use correlations. If you find something that has a very strong correlation and you find the one that is typically the driver, so for CAD yen that is oil, you can often trade it when there's a bit of a divergence, right? So the divergence here was the fact that CAD yen started to really kind of roll over around this kind of section here, and it was kind of breaking into new lows, especially on the minute time frame. And the market came up into these kind of 15-minute highs, and I could see that we were kind of rejecting here. But look at that, oil prices started to go, and then what happened about 15-20 minutes later, or sort of 30 minutes later even, the market then started to roll with it, and we had this really nice kind of downside play with the market kind of, you know, pushing in lower. And again, you know, there's other things that we could look at here. So we had a big sell-off here, took a while, but then the market started to sell off, rallied, then the market rallied. So you can see that there's a slight delay between CAD yen and oil prices, and I just wanted to bring that up because I think this is really interesting. One thing that I like to do as well, let's say I'm trading dollar yen and the market is in kind of a risk off mode, go take a look at dollar Swiss, because you can gauge which one is the stronger out of the safe havens, and then you can try and, you know, trade this sort of divergence between the two. Let's say dollar Swiss was pushing aggressively lower and dollar yen was rallying at the time, then, you know, I would happily look to go short dollar yen because the sentiment of the market is with dollar Swiss at that point. So just wanted to bring that up. We can go take a look at dollar yen now, and then we'll go over to euro pound. What I'll do as well is bring up the currency strength meter as well, and we'll have a little look at what's going on for this week. So when it comes to Japanese yen right now, +5, so still a strong currency. Swiss franc is the strongest. US dollar sitting at -2. So my sentiment really is still dollar yen lower right now, has been for majority of this year. And you can see from this weekly chart, you know, we're in that kind of phase one on the weekly. We're coming into these key critical swing lows down towards 142s, 140.50s now. So, you know, do I want to get short here right now? Probably not. I'll probably want to see that kind of rebound first before seeing a continuation lower. But I do feel like dollar yen markets are still going to continue to kind of create this downside for the time being, at least, due to the, you know, one of the obvious reasons is the fact that the Japanese yen is a stronger currency, and we're starting to see that the Bank of Japan are becoming a little bit more vocal in terms of hiking rates. So we're yet to see that come. We are yet to see that come. Data for Japan not necessarily backing up a rate hike just yet, but if we start to see sort of inflation figures rise and things like that, that's what this central bank in Japan is focusing on at the minute, is inflation. So if we do see inflation rise there, then I think the Bank of Japan will hike. I think we'll see some further downside to the Japanese yen, very much like what we've been seeing with the Swiss franc of late. But yeah, I mean, one thing we did kind of look at was the correlation between dollar yen and the US 10-year yields. That correlation has been kind of decoupled over the past few weeks, especially because, you know, of the situation in terms of the sort of bond market. So, you know, when I look at that, I think to myself, is there a point where one of them catches up with the other, and which one is it going to be? Now, usually US 10-year yields move first, dollar yen follows from that. So there might be a point where we do see that kind of snap back, and we do see dollar yen go and sort of rally in line with the US 10-year yields. But we need to see markets, I guess, normalize first before that, you know,
potentially happens. But we are approaching some key lows coming in on the dollar yen price right now. So maybe, just maybe, when we come into these kind of 142s, 140.50s, maybe that is the moment where we start to see a bit of a rebound in dollar yen prices, and we start to see sort of a move back up towards that kind of 148.75s or whatever. Because it's interesting, isn't it, with the situation, like I said before, usually I would look at the US 10-year yield and say to myself, well, there's probably a good opportunity that the dollar's going to get stronger. If we see if you just go to US dollar index, for instance, again, just hit that compare tool, you'll see that when you see the US 10-year yield kind of rally, dollar goes with it, right? When it falls, dollar falls. When it rallies, dollar rallies. When it falls, dollar falls, so on and so forth. And they have a really strong correlation, right? But that's not really there right now. It's not there right now. And the market is kind of, like I said, decoupled away from that sort of narrative at the minute. And that's ultimately why Donald Trump paused the tariffs and gave the 90-day pause, because the bond market was selling off aggressively. And that's not necessarily what he wants to see, because usually that also relates back to sort of inflation expectations for the future as well. So, if you see yields higher, inflation expectations higher, higher interest rates, you're not really... that's not really the narrative of the market right now. The Fed are wanting to cut interest rates. Yes, expectations from consumers are that inflation is going to be higher, but I don't actually think that is going to be the case. I actually think inflation will come in lower. So yeah, really interesting kind of dynamics in the market. I think this is one of those weeks where it's kind of like, what is going on, and how can you kind of benefit from that is very difficult to tell at the moment. So yeah, dollar yen, I still, in the short term, I don't think nothing's really changed that much. The only thing I would say is that this move here is kind of overextended now. I want to be trading the secondary phases turning into those primary phases. So like these kind of turning points here. And the way I try and do that is by looking at lower time frame sort of changes in trend. So we look at the 4 hour or 1 hour, for instance. If we look at the 4 hour here, the market is trending up. It then starts to break into new lows and the market trends lower. Similar situation here, although we had that kind of large spike to the upside. But you had that kind of double bottom, move higher. We then made new lows and the market continued to the downside there. So right now, I don't really have that situation. Don't really have that. The market needs to pull back before continuing down. That being said, though, Vincent, your take on euro pound would be something interesting to me right now. Hi, just nothing. Hope you're well. Going down to euro pound, we're starting to see that kind of big move down. So I was very bullish euro pound. Market has since obviously skyrocketed to the upside when we had that whole situation with the euro and whatnot, and we've seen that kind of big move up, and we've come into some very critical levels on the sort of weekly chart. I've actually broken significant highs. You can see 1, sort of 2, 3, 4. Don't think it quite broke that high just in there, but 4 significant highs, and pretty much the entire downward trend of 2024 has been sort of reversed in a matter of 4 months of 2025. So that's quite interesting to see. I still like euro pound long because I'm short pound. I think when we look at the sort of not just the currency strength meter, but that is one of the weaker currencies right now. But at the same time, data out of the UK hasn't been particularly fantastic, and growth forecasts when it comes to GDP are still very low. So I still like the idea of being short pound. I don't think that narrative has gone away yet, because we're still seeing labour market data pretty good. So
as long as that remains, I think that we've still got a good chance of getting in on the pound move. If we start to see the labour market data come in poorly, then there is a strong opportunity then for the Bank of England to sort of cut interest rates and things like that. So I think the pound will then start to kind of move a bit aggressively lower. But that being said, we've got this kind of nice bullish upward trend here. Let me just change the session breaks off here. Look at the daily chart. Still really nicely bullish here. Market making higher highs and higher lows. You know, we're in that secondary phase now. So I'm just watching. I'm watching this 4-hour time frame. I'm going to wait to see if we get some kind of double bottom form, some kind of change in trend form. And then, you know, I'll have a little look at potentially getting long this market. We're at these kind of significant lows from last week where the market rallied higher. You know, I actually cut my euro pound long. I was long euro pound and short pound Swiss. And I cut my euro pound long to go short pound Swiss with a bit of extra risk, which worked out for the better in the end. But I could have double bubbled there because euro pound rallied and would have hit my 0.87 target. But either way, you know, we've come back down. I would like to see some kind of consolidation, maybe some kind of stabilization of this move, because looking at this right now, it's gone straight up, straight back down. So, you know, if we could get some kind of consolidation and a breakout, then that would be more appealing to me to go long this market. Or if we get some kind of lower high, maybe look at some kind of trend line break and see if that trend will continue. But as long as this daily trend remains pretty bullish on euro pound, I'm happy to be a buyer of this market, just waiting for an opportunity to do so. Irfan, sorry, let me put your comment up. Hope you're well. Had a good pound CAD 100 pip trade today. Like it, still like it to the upside. What is your take on it? CAD numbers are bad today. Yeah, yeah, that's an interesting market. Yeah, I think CAD is a little bit weaker right now. Starting to see that kind of upside there. Honestly, I am a bit more bearish on the pound. Weekly chart looks pretty good though. We've broken into that kind of out of that consolidation. We've come back into it, found some kind of support here, and we're starting to see buyers step back in. So, you know, that's not a bad shout. I guess you were long down towards these kind of 8,200 areas. And we're seeing that little bounce up, but you can see on the daily chart, we have that kind of corrective pattern right now. So maybe we'll see a little bit more downside from that. It depends as well, you know. What if we see kind of like a turn in oil? I am long oil right now, but at the same, I'm short oil. But at the same time, if that starts to flip, it actually starts to become a little bit more bullish because it's been bearish for a while now. So the market might consider changing its opinion on that. Then CAD might get a little bit stronger, and it might drive this market a little bit lower. But you know, at the same time, look at this weekly chart, still very, very bullish here for pound CAD in particular. But a couple of markets are like pound yen short I quite like. Aussie and Kiwi having good performances today as well. I mean, I looked at Kiwi Swiss earlier, that's flying up. Again, that's kind of that unwinding of that sort of risk off. You're starting to see risk currencies perform well. Same with Kiwi yen, Kiwi CAD also kind of flying up to the upside as well. So yeah, I mean, we're starting to see a little bit of positivity when it comes to sort of risk currencies. So pound Oz in particular dropping back quite considerably, as well as pound Kiwi kind of breaking through these lows. So you can see that pound is fairly vulnerable, considering the fact that Aussie and Kiwi have been so weak for so long. You know, look how much it's giving back of that. So I want to try and trade that. Do I want to go and trade that against Aussie and Kiwi? No, because obviously we still have the situation going on in the background. But I do like pound Swiss. So short through this period down through here, looking to get short again. Again, just kind of watching trends on lower time frames, see if we can get this kind of secondary phase turning into a primary phase again and moving on to the downside. Very similar, you know, with euro pound for me on that one. I'm a little bit cautious. I'm a little bit cautious on euro at the moment. Big part of that is because although I do like euro strength, and if we just kind of have a look, euro's still holding at the kind of +3s. So, you know, still quite like the idea of being on the bullish side. I'm still a bit skeptical because of what the spreads between the sort of yields are doing. This is the EU 10-year minus the US 10-year. So basically just the sort of spread between the two. And I like to follow this quite closely. Again, if you kind of compare euro dollar prices to this, you can see why, right? You know, they hug each other pretty well, and usually yields will go first and then the currency flows will happen slightly after. And we've got that, again, that kind of separation between the two. So yeah, very interesting markets at the moment, making it very difficult to find real solid kind of trading ideas, in my opinion, because I look at that move there and think, well, what if the bond market reacts in a very similar way again? Are we then going to start to see dumping of sort of your G7 currencies, and, you know, dollar gets stronger again? You know, that's something we've got to consider. Because this dollar weakness has been there for a while. It'd be interesting to see if 10-year breaks 5%. I think if we see a similar situation right now, we're at 4.38 at the moment, so it's not too kind of out of the sort of picture of a break of 5%. But the last time we reached this sold off aggressively. Dollar sold off aggressively. So I'll be interested to see if the market can break through these highs. If it does break through these highs, and let's say we've got a similar situation right now where the dollar is a lot weaker, but we break 5% on the 10-year, I think we'll start to see a flip in that narrative, and I think we'll see dollar strength, quite considerable dollar strength at that point. So this is a real kind of marker for me at the moment, that 5% on the US 10-year yields. The closer we get to that, the closer I think, you know, we start to see sort of dollar start to rip higher a little bit. I mean, we are at a key point. You know, we're at these kind of key swing lows, 99.88. You know, we broke out of this previously in the past, and the dollar went on a big surge back in 2023. You know, after we broke these lows here, there was a big talk. I mean, I think I was one of them, to be honest, that this dollar could continue to push lower towards kind of the 98. It didn't happen. Closed back above dollar, ripped higher again. So, you know, are we going to see sort of a similar situation here? You know, we have to think about that, because Trump wants a weaker dollar. He wants lower inflation. He wants interest rates lower. But if he continues down the path that he's continuing on right now, will he get it? You know, and will the bond market kind of force his hand? You know, that's a big question in the markets at the moment. So let's go take a little look at the S&P 500. I just wanted to bring on some seasonal charts and kind of show you those before we go into anything else. So let's have a look. So this is the seasonal chart of the S&P 500. What I found really interesting about this is, so let's just look at the past 10 years, and let's look at the performance from February 16th, okay, where we saw that kind of drop in the stock market, to kind of current time, so 15th of April. Okay, so typically we do see that kind of downward period, right? But usually in the past 10 years, just on normal market conditions, we get a drop between February 17th or February 16th down to 23rd of March, and then we usually see a little bit of a recovery in the 23rd of March. Didn't get that this time, right? If we look at what happened sort of the 17th of February, where the seasonal sign that the market typically tops, we had that downward move. However, this time we've started to rebound around the 7th of April. What I find super interesting about this is if we go to all years, right, And I'm just going to check post-election years, okay? Because that's the year that we're in right now. Obviously, Trump got elected. We're in that post-election year. You can see that actually the market is performing in a very similar way. So usually we top this time around the 6th of February, and that usually lasts down to the 7th of April, right? And that has a very strong win rate, 64% win rate, with an average return of 2.34%. Obviously, we know the markets have fallen a lot lower than that recently. But nonetheless, very interesting, because what we can actually do, or what I did do, let me just grab this a second. I overlaid the charts together because on Season X, it doesn't do it very well. So I actually did it myself. Let me just grab that. There are two charts that I want to really show you here. Let me just see if I can I'll download the two images and we can have a look at them, because I just thought they were super interesting. Let's see. Let's get this one up first. See where this pops up. Okay, right. So this is what I'm talking about. So what I've done here is I've took the post-election years, okay? And this blue line is the typical performance. What I'm going to do is just change the view so you can see it a little bit bigger, okay? So this is the average, okay? So this blue line is the average performance, okay? And then what I've done is I've overlaid the current year's performance. And what I found was really, really interesting. So first of all, we typically top in February on the previous kind of data and post-election years only. It's usually sort of around about the 6th of February. And that usually lasts until the 7th of April, obviously with a little bit of a bump in between that as well. However, look at the performance that we've had this year, right? Very similar performance, in my opinion. A little bit of upside at the start of the year, but then just kind of like a slow grind higher before seeing a drop. Well, that's kind of what we had. We had a bit of a slow grind higher, and then the market dropped. It then rallied a little bit, and then it significantly dropped again. So kind of sparks the question in you that, yes, we've got all this kind of situation with tariffs and all that kind of good stuff in the market and all this kind of macro data, but from a seasonal point of view, they pretty much nailed it on a seasonal in a post-election year. Usually we find support down on the 7th of April, and that lasts until kind of summertime, usually late July, start of August, with a quite a decent sort of rate up until kind of May. So is that the kind of period we're in now? And to kind of back this up, I wanted to then kind of look at the volatility index, because I think that's where we need to look. I don't think you necessarily need to look at the individual sort of stock indices at the moment. I think we need to look at sort of sentiment, right? I think sentiment is the big driver in the market at this current moment in time. So that's what I'm looking at. So this is the volatility index. Again, blue line is the average seasonal chart. And then I've overlaid the current year's performance, so 2025. And you can see, again, we've got some very strong similarities. Usually in February, we bottom and we see a rally in the volatility index. We had that. March, we see it come down before rallying again. We did that. We've had a very similar impact in the markets. Now, what I find interesting now, though, is that what we typically see is this kind of downward trend in volatility until July, okay, which I think is quite an interesting thing to look at. We do have some peaks within it,
right? But at the same time, the overall trend is down until July, where we usually see a very strong pickup. So I'm going to be monitoring the seasonals very, very closely when it comes to things like the volatility index, because if we do see volatility fall, what does that mean? Well, we usually will see sort of risk assets rally on that. So maybe we'll see strong Aussie, strong Kiwi on the back of that. We'll see maybe a weaker Swiss franc, weaker Japanese yen. And we'll also see stronger stock markets. Okay, that's the general thesis around, you know, volatility and markets. So I'm going to keep a close eye on that, because even in this downward trend, it shows us that we're potentially going to get a couple of rallies, and these areas here could be really good opportunities for me personally to have a little look at some trades when it comes to volatility in the stock market, or whether it's volatility and looking elsewhere like dollar yen, dollar Swiss, or Aussie yen, Aussie Swiss, things like that. Those could be good markets to have a look at in those conditions. But it does say that July we usually see quite a decent ramp up in volatility, and if that's going to be the case, maybe there's some opportunities in July to see that kind of move in the stock market. Because at the moment, I think we're kind of teetering on the edge when it comes to the stock market of where we're going to go next. Are we going to see another decline? I am personally on the side of, I think we'll see another decline. Do I know if there's going to be one? Absolutely not. If I did, I'd be putting the house on it, and you know, I probably wouldn't be talking to you guys right now, right? But at the same time, look, the market has been trending lower. I don't think that trend is necessarily going to end until we see something significant. So whether that's a Trump, you know, or I keep saying Trump China, but US China deal, then that would be fairly positive for markets, right? Considering how it's reacted throughout this kind of time. So I find it interesting just to kind of, you know, look at those kind of sentiment indicators, look at the seasonal, and actually think, you know, when I looked at the seasonal, I was kind of shocked. I was a bit like, oh, even though we've had all this kind of tariff nature going on and all this poor data, it still followed some kind of seasonal pattern that has been historical patterns within the markets. I just find that super fascinating. So I just wanted to show you guys that, to be honest. So we'll see what happened from there. Yeah, Irfan, interesting analysis. I'm also looking at areas where I'd be interested in investing. I believe we might get another dip. We'll be interested if the S&P gets around 4,500 or lower. Might be around July. Yeah, it might be around July. You know, might be sort of this calmer market until July, and we might get that kind of dip down again, and then, you know, a bit of a recovery in sort of November, December, because usually volatility falls away in those months, and that's where you get the kind of Santa rally talks and things like that, because volatility usually dies off in November and December, and that's when you can get these kind of bigger moves in the market. So yeah, will be interesting. I think you know, maybe we'll kind of put a pin in this one and have a little look back at the time and yeah, see what happens over the course of time. But you know, at the moment, stock markets are falling. If we look at it from a monthly time frame, look at this. It's not. Let me just hide those drawings. When you look at it like that, you know, everyone's panicking, but at the same time, look at it. You know, it's a very strong upward trend. I've never really seen a bear market, right? In my trading career, there's not been a bear market. There's been sort of bearish moves, but there's not ever been a bear market. So maybe, you know, if we start breaking those kind of 4,500s where you're looking at Earth, and then maybe there's something to kind of go on that this is a lot more serious than what it is. And at that point, I think obviously there's global recessions and it's probably looking a bit awful out there if we're going to get below that 4,500. You know, but there's a lot of talk about usually the typical fall on one of these moves is around about sort of 30%. So 30% would really bring us to about 4,000 around those kind of points from the high to low. So 2022 was 27.5%.
2020 was only 35% when you think about it. Let's see if I can get the futures market up. Let's have a look at the ES, because I think that'll go back a lot further. That goes back to 1998, because we can have a little look at the 2008 drop was 57%, and also 2000 to 2022 drop was 50% as well. So let's say, for argument's sake, the stock market falls 50%. You know, where are we looking at in terms of price? It's going to be looking around about $3,000, isn't it? Which makes sense, because we tried it, the highs were 6,000. So, you know, that would be a very significant point in the market, wouldn't it, if we ever got down to that point? But again, I think that's a big ask. I think that's a big ask. Can it happen? Yeah, I mean, nothing's off the table. It's all probabilities at the end of the day. But I think we're going to have to see something very significant in order to that. I think we're going to have to see unemployment push beyond 5%. It is forecast to try and creep near 5%, but no one's really forecasting a break above 5% right now. I think if we start to see sort of unemployment climb and things like that, then yeah, you know, I would be very, very cautious about sort of being long in the stock market at those points, because really that's going to be it could be the final kick for everything to go, is when unemployment really rises. And we're not really seeing that at the moment. We're not really seeing that across global markets right now. So we shall be keeping an eye on it. But it's just an interesting topic to discuss, isn't it? Because obviously, you know, I think people would have probably bought the dip here. I know when we go take a look at the commitment of trader reports, we did see some buying of the dip. So when we go take a look at indices here, we can see that we did see some buying of the dip, especially NASDAQ. You know, they bought NASDAQ fairly heavily, reduced those long short positions, increased their long positions, which meant net they were up 9,000 contracts when it comes to the NASDAQ. And this is the current trader reports, non-commercials. This is your large speculators, hedge funds, people like that. So, you know, on the S&P, they didn't. You know, they decreased their positions. They increased shorts, but also increased longs, hedging. But their overall positioning was minus 9,000. And you can see that from positioning here, they are skewed more bearish on the S&P 500. Same with the Dow Jones, right? So if you look at the Dow Jones mini, that was up 3,000 contracts, but they are more negative on the Dow than they are the NASDAQ. And why is that? You know, we have to ask ourselves. So obviously the NASDAQ is more on the side of tech, right? And obviously tech is a little bit more of a market that could be, although the valuations, I think, are overvalued in a lot of those markets, technology could actually perform better, because we still need it from a day-to-day life. That is the market that's expanding as well. Obviously the Dow is more kind of like an industrial side of things. So, you know, it makes sense that this market is a little bit more vulnerable to any kind of shocks, right? So S&P obviously has the top 500 companies in it, but a very concentrated risk on the sort of the top 20. So, you know, once we saw those valuations come down a little bit, the S&P is being hit by this as well. So yeah, I mean, very interesting kind of topics to talk about at the moment when it comes to markets, but it makes it very difficult. Now, if we go take a look at currencies, some things that I find very interesting is look at the pound, minus 17,000 contracts on the pound. Again, heavily skewed more towards a negative pound. So that kind of backs up my theory of being short pound when it comes to poor data out the UK. Canadian dollars, they're plus 10,000. Japanese yen, plus 25,000 at an extreme still, though. So that's a 52-week high now. You know, so they are still pushing extremes when it comes to the Japanese yen. Swiss franc added 12,000 contracts long. Again, the Swiss franc has been outperforming most markets recently because of that lower interest rate. And, you know, I think we could now see the Swiss National Bank even try to go negative rates, or even try and maybe there'll be some kind of intervention from the Swiss National Bank, because they did discuss previously that they didn't really want to see a super strong Swiss franc. They didn't want to see a super weak Swiss franc. Now they've got a super strong one. So are they going to try and intervene within the markets potentially soon? Australian dollar as well added 12,000 contracts long on that, added 5,000 contracts in New Zealand dollar. So, it looks like they're starting to build up long positions on sort of the Aussie dollar. They're still kind of looking at longs on Swiss franc, Japanese yen. And obviously these could be different traders doing different things, right? But you can see that the pound is the weaker out of those. So for me, pound I like short. I like pound short, but it's just finding an opportunity to do that. Okay. One of those markets is obviously pound Swiss. But has that Swiss ship sort of failed or sailed, sorry, because we're kind of at this significant low, right? So are we going to see that kind of continuation at the moment? Who knows? Maybe it will pull back up into this 1.09 and then we can look to short again. Pound Aussie makes a ton of sense now after looking at the commitment of trader reports. That makes a ton of sense. If they are bullish Aussie, bearish pound, then that could be a market that pulls back as well. Look at this weekly chart, has been fairly bullish for a period of weeks. Maybe it'll come back and try and test this kind of 2.025 area. I'm just, again, very cautious on Aussie longs just because of the situation. But if we do see huge changes in terms of the narrative there between Trump and China, then there could be some positive things coming out of it, right? I was just having a little look. Let's go on to Donald's Truth Social. See what has been posting there. Okay. So 2 hours ago, he started to talk about NVIDIA commits $500 billion to build AI supercomputers in the United States. I mean, that's the thing, though. What are manufacturers going to do? Because are they going to spend millions or billions of dollars to build plants in the US when, in theory, this guy's not going to be here in 4 years? Unless he does something where he changes the policy or whatever, and he pushes that through that he can take another term, which hasn't been done for a very long time in history in the US. But are they going to risk doing that? Because what if he then gets booted out, somebody comes in and they just reverse everything he's done? It's a very big risk for markets to do that. So what I feel is going to happen at the moment in terms of stocks is I reckon they'll just swallow the costs, right? So in terms of, and what I mean by that is, so Nike, right? Let's take Nike shoes, because I've seen them blowing up on social media recently because everyone's found out that they produce their shoes in China for $10 and then sell it to Americans for 120, 130. I mean, they sell it in the UK for like 150 quid, which is just outrageous. But at the same time, are they going to stop manufacturing in China? Let's say these 100% tariffs on China, and it costs them $10 to make the shoe in China. It's now going to cost them $20 to make this shoe. They still have a decent margin on that, right? So I think a lot of sort of manufacturers are going to swallow the costs rather than pass the cost on to the consumer at the end of the day. Because if they start passing on that onto the consumer and that $120 shoe now becomes $140, $150 shoe, then they're going to be pricing themselves in a particular place where Americans might not be able to afford that. So I think later down the line, you're actually going to see sort of earnings coming a little bit lower if this situation remains, because a lot of big US or US retailers, markets, a lot of their stuff is produced in China.
because it's cheaper labour, and they take advantage of that to boost revenue, right? So yeah, very interesting there, and I think that could be a big driver into sort of the downside coming for potential stock markets as well. Hi Abraham, how you doing? Any trade on this? I'm flat this week. I am in 2 trades. Let me show you. Sorry, I haven't even actually showed you what I'm in. So I'm still technically silver long, right? I'm long down towards this $30 level. My stop loss is below this low now, $30.50, and I'm looking to see if this will kind of continue. It's looking pretty squeezed at the moment, right up at this high here, which is that 32.42, where we saw that kind of second leg sell off. So if we can breach that high, I think we'll see higher prices here. If it doesn't and we start to break lower, I'll cut this early and get out of this for a very, very minor profit. If we start to see huge downside in stock markets again, everything will be sold off. Everything will be sold off. So whether it's gold, silver, whatever, they'll be sold off. We saw that here, right? When the stock market fell, silver was one of the hardest hit. If the stock market does that again, that will probably happen again, right? So I don't want to be at risk of losing the gains that I've made here. I am still short oil. Short oil pretty much from this kind of 62.50 area. Nothing's really happening here right now. I do still quite like the idea of oil short, but I'm getting a little bit wary on it, because when I looked at a couple of commitment of trader reports, let me have a little look at energy, and we look at crude oil. I mean, look at that. Let me go to, sorry, clicked on the wrong thing there. Let's go back. Look at the positions, right? What I wanted to do is go here. So typically when I see this happening and I see that short contracts from hedge funds are at an extreme, I'd be looking to buy this. So, and look at that weekly close, right? So I am short for the time being. And if the market breaks higher, I will get out of that position, because obviously I'm in at the wrong point at that point. So I've only got a very small risk on that trade. So I'm hovering around sort of break even. I actually got short. I'm just looking at it on the other screen. I actually got short just below this low here, 61.60s. So basically short on that candle low, and my stop loss is 65.20. So my stop loss is here. Target is down at 54s. So that's the trade that I'm in right now, and I'm at break even. But you can argue there's a head and shoulders here, although we've gone pretty sideways. And then there's a flag pattern, pennant pattern, whatever. So yeah, at the moment for me, I'm below the 50 moving average. If that gets taken out and then the market closes above these highs, then I'm likely going to get stopped out. But I've taken a very small risk on this. I don't even think it's 0.25? 0.25%. So that's kind of my feelings of the market at the moment. I want to be involved in a few things, but I don't want to apply a lot of risk. That's where I'm at right now. So even silver, I'm long. We're up, how many dollars? We're up to just over $2.5 on that trade. I mean, yeah, I'm long. I'll stick long for now. If it can, we've broken the 50 moving average on the daily chart. So I'd like to see us just pump up a little bit higher. If it can, fantastic. If it doesn't, it doesn't. But I've only taken a very, very small risk there. And my stop loss, I've cut in sort of into a quarter of what it was. So yeah, but other than that, I am flat. I've not really gone into anything else. Like I said, the only couple of markets are really like a pound shorts right now. I'm keeping an eye on pound Swissy, pound yen as well. We're back up at sort of that 189.50 where I wanted to be short in the first place. Sorry, that was at
194.50. Now we're at 189.50. I want to look to maybe see if this downside will continue as well. So just watching the lower time frames again, we've kind of slowly had that kind of pump up higher on that 90-day tariff pause, and we've slowly made our way back up. So if we do see some big selling coming in here and we break that 50 moving average on this hourly chart or something, and we start to see sentiment turn lower, I quite like that short. So a couple of markets that I'm keeping my eye on, but other than that, there's not really a lot. I think we're just kind of sticking in this real awkward sort of positioning right now. But we can see some markets are moving. Aussie Kiwi, I like the downside of. I didn't get short again, although we did get a bit of a spike higher, and I did consider it, but I just didn't get involved again, because unfortunately, missed out on this big sort of 5-6 to 1. I ended up banking like 1.7% out of that, and that kind of tanked lower. So I think for me at the moment, being flat isn't a bad thing. If you're uncertain, then just chill for a little bit, wait for the uncertainty to die off, and then wait for normalization. It's not a bad idea. I guess if you're trading sort of prop capital, that might be difficult, because I know that some prop capital firms have a sort of 7-day inactivity. So that's one thing I would look out for. If you trade with prop capital, keep an eye on your inactivity, and maybe just place like a 2-minute trade and things like that, just to show that you've got activity sort of going, whether it's a winner or loser. Just risk the lowest you can, and just make sure that the activity is still there within your accounts. So that's one thing I would say, keep a very, very close eye on. Right then, guys, other than that, not a huge amount going on. Obviously, we could talk about the potential for dollar to rally if yields continue to push higher, then maybe. But yeah, other than that, it's a bit of a coin flip right now, and that makes it very difficult trading conditions. So I'll leave it there. I'll be back with you on Thursday. Maybe I'll pick some kind of topic and we'll go over it, and we can have a little chat. Depends on how the market's moving by then. Hopefully we've had some things move in our favor, or there's maybe something's happened that we can talk about a little bit more deeper. But I'll see you on Thursday, and yeah, I will catch you guys then. Thank you for your time today. I appreciate you all. If you could leave the stream a like, I'd enjoy that. And yeah, speak to you guys soon. Thank you.